Warren Buffett, who is often referred to as the Oracle of Omaha, is one of the most successful investors of all time. His journey to financial independence is a testament to the power of compound interest. With a net worth of over $100 billion, his investment strategy has made him a household name in the world of finance. But what makes Warren Buffett different from other investors? How did he gain such a massive fortune? In this video, we're going to look at how Warren Buffett turned compound interest into a path to financial independence. So make sure you watch this video to the end. If you're new here, make sure to like this video and hit the subscribe button. Let's begin by explaining the power of compound interest. Compound interest is kind of like a special ingredient that helped Warren Buffett become super wealthy. Here's how it works. When you put your money into an investment, you not only earn interest on the original amount, but also on the interest you've already earned. So over time, your money can really start to pile up. The longer you let it sit and grow, the more powerful this effect becomes, turning even small investments into big fortunes. It's like watching your money grow on autopilot. You decide to invest $10,000 into a savings account. This account gives you extra money each year, called interest. Let's say it gives you 8% interest annually. After 1 year, you'd have $10,800 because of the interest. But here's where it gets interesting. In the second year, you don't just earn interest on the original $10,000, you also earn interest on the $800 you got from the first year. And this keeps happening every year, making your money grow faster and faster. Warren Buffett's early investments and the role of dividend stocks. When Warren Buffett was young, he liked to invest in stocks that paid out dividends. He started when he was just 11 years old by buying 3 shares of Citi's Service Preferred for $38 each. Even though the stock price went down to $27 later on, he believed in the idea of dividend stocks. Dividends are payments that companies give to their shareholders from their profits. Buffett understood that by getting these regular payments and putting them back into the stock, he could make even more money over time through compounding. Warren Buffett's plan was to find companies that regularly paid dividends and had a good track record of making money. He liked investing in businesses that were really good at what they did and had a bright future ahead. By picking these kinds of companies, he was able to generate a steady stream of income that could be reinvested and compounded over time. How compound interest played a crucial role in Warren Buffett's financial success. Compound interest was really important for Warren Buffett's success with money. He didn't spend the extra money he made from his investments. Instead, he put it back into his investments, and that extra money made even more money over time. This helped him become super rich because his wealth grew faster and faster. The key to Buffett's success was his long-term approach. He knew that when you invest money, it grows over time. Instead of trying to get rich quickly, he chose to invest in good opportunities and held on to them for a long time. This strategy let him take advantage of the snowball effect, turning his early investments into a huge amount of wealth over many years. So, how does Warren Buffett choose his dividend stocks? Warren Buffett is very picky about the dividend stocks he chooses. He doesn't just throw darts at a board or go with his gut. Instead, he dives deep into researching companies and carefully analyzes them. What he looks for are companies that stand out from the competition, ones that have a solid history of regularly paying dividends, and those with a business model that's built to last. Buffett's philosophy is all about investing in things he understands inside out, things he can confidently say will do well in the long run. So when he's picking dividend stocks, he's really thinking about the big picture and aiming for steady, reliable growth. He believes it's smart to buy stocks when they're priced reasonably. He searches for companies that are undervalued, meaning their true worth isn't reflected in their stock price yet. By doing this, he aims to invest in businesses that can grow in value over the long term. This approach helps him earn both regular dividend payments and profits when the stock prices go up. Lessons to learn from Warren Buffett's investment strategy. Here are 2 important lessons from Warren Buffett's investment strategy that you can apply to your own financial journey. Firstly, patience is key. Buffett didn't become successful overnight. It took him many years of steady investing to get where he is today. When investing, you need to think long-term instead of just focusing on short-term gains. When you let your money grow over time, it can become a lot more because of compound interest. So it's best to avoid trying to make quick profits and instead think about the future. The second lesson we can learn from Buffett is the importance of understanding what you invest in. He suggests that, as an investor, you should focus on what you know best and invest in companies you understand well. This will help you make smart choices and lower the chances of making hasty, uninformed decisions when investing. Here are some practical tips for using compound interest to achieve financial independence. To make compound interest work for your financial independence, here are some simple tips you have to remember. First, you have to start investing as early as possible. The sooner you start, the more time your money has to grow. Time is super important when it comes to making your investments grow with compound interest. Secondly, be consistent with your investments. Consistently adding money to your investment collection, like your retirement savings, index funds, or stocks that pay you dividends, helps your money grow steadily over time. This steady growth lets you make the most of compound interest, which means your earnings can increase even faster. Lastly, diversify your investments. Warren Buffett recommends spreading your investments across different types of assets to lower your risk. This means putting your money into a mix of things like stocks, bonds, and real estate. By doing this, you are less likely to lose all your money if one investment doesn't do well. It's like not putting all your eggs in one basket. And by spreading out your investments, you have a better chance of making steady profits over many years. Compound interest can seem tricky, but there are helpful tools and websites out there to guide you through investing. Websites like Investopedia and The Motley Fool offer easy-to-understand articles and guides about different investment strategies, including compound interest. Financial calculators are helpful tools that can show you how your money could grow over time. You can use them to figure out how much your investments might be worth in the future by putting in details like how much you start with, the interest rate, and how long you plan to invest for. Warren Buffett's story of going from receiving dividends to achieving his dreams shows how powerful it is to keep reinvesting your earnings over time. Through long-term investing and letting his money grow through compound interest, Buffett transformed his initial investments into a huge fortune. So, if you want to be financially independent, you have to invest your money wisely and be patient about it. Don't expect to get rich quickly. Instead, think long-term. Understand how compound interest works. Remember, it's like a snowball effect where your money grows over time. You have to make smart decisions about where to put your money, and over time, you can become financially free. There you have it. So, are you ready to take control of your finances? Start your journey to financial independence today by taking the first step towards investing in dividend stocks and understanding the power of compound interest. Let me know if you found this video helpful. Don't forget to subscribe and hit the bell to receive all the updates. Also, make sure to leave a comment below if you have any questions about this video. See you next time.